Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. We're going to try to answer your questions about retirement planning, asset management, tax planning, all in hopes to be able to, improve your retirement, especially in the area of finance. And we've been doing this show for quite a while now, really enjoying it. Send in your questions. We can answer them live. You can send them in during the week. We can answer them next week when we do the show again. Again, here we are. Ask Tom at talkmoneywithtom.com, and then you can put them in the chat if you'd like to also. You can subscribe to the channel. Hit the subscribe button and the bell button to get notified when we send out new things. We just feel strongly that the more you know, the more educated you are about these three areas, the better off you'll be, even if you have an advisor. And of course, the last thing is you can ask questions on a one-on-one basis with Ethan and I. You can go in and set up an appointment. There's a book appointment button. Looks just like that on our website. The link for that is on this web page also. So you can set up a 30-minute time to meet with Ethan and I, and we'll sit down with you and phone, video, in person, whatever works for you, and answer some of your questions. So really looking forward to today's show. Please start sending in your questions, and we'll be ready to answer them as they come in. All right. But I always like to start off the show each week with a conversation about what we saw happening in the stock market this week. And so I'll share a chart here for starters. So kind of a bad week so far. Yesterday we had a red shirt day. So for those of you who watch my daily videos, I wear different colored shirts depending on what the market did that day. Red is for more than 1.5% down, and green is for more than 1.5% up, for example. And I just mentioned last week that it had been over 100 days since I'd wore a red shirt.
Yeah, you might have jinxed it there.
Maybe. And that goes back, it was an article I saw, that went back to 2018 since that's happened the last time. So it also kind of means that, things had gone long enough before we had something like that. I mean, it's sort of like averages tend to work out. And that's kind of my theme here. That's happening and that I've been talking about for a while. You can't have the types of run-up that we've had this year without some type of consolidation and pullback, in my opinion. And it's what I've been talking about really since July. And today is just kind of the same type of thing. And so, we have a lot of headwinds coming at us, but we kind of always have some headwinds, right? You can always pick out something. We have an auto union strike happening on a rolling basis. We have a possible government shutdown coming at us here at the end of the month. We've got rising oil prices, and all of these things, are feeding into this, picture of gloom, I suppose. And the Federal Reserve, of course, just had their meeting, and they're trying very hard to get the market to come down, at least with their words. And they're talking about keeping rates up for longer, and what have you too. So, having said that, when you really break everything down and you kind of take that aside, there's an awful lot of positive things happening right now. Company earnings continue to do well. The consumer continues to spend. The whole thought process of recession has now been tabled. It's amazing. I mean, article after article after article last year talking about recession, first half of this year, second half of this year, and that's all gone. And why is that gone? Because we're basically seeing inflation slowly but surely coming down. We're seeing the scenario where the Fed has paused now 2 out of the last 3 meetings, right? And the one meeting in between was only a 1/4 rate increase. Maybe they do it again in November, but the signs are here that things are getting a little bit better in that area. And we're at the moment we're in this kind of soft landing zone. We may not stay there. We may skyrocket upward or fall downward, but that's where we're at, and that's where we've been at for quite a while. And both Chairman Powell, the Federal Reserve Chairman, and Janet Yellen, the Treasury Secretary, have both been talking about this data that they see showing a fairly strong economy. We saw, this week, the first-time unemployment claims was quite low, lowest it's been in months. And so, the job market continues to be really strong, and that offsets a lot of these other bad things. And so I think that there's enough here. And then we need to look at the market as a whole and what is trying to tell us. And so I'll show you this little line here. So at the moment, I just put a little line right where we're at. Got a little bit of support right there. We're bouncing a little bit today. And however, the big support is just below that, kind of 4,200. We're
Yeah.
at 4,300 now, kind of that 4,200 to 4,050 range. You can see a big jump of pricing in that area. And so the idea behind support is that the market spent a lot of time at one particular price, and a lot of shares were purchased at that price. And then it goes higher than that price, and people say, wow, good, I made money. I'm glad I bought it at that price. And then when it comes back down to that price, people would say to themselves, hey, I made money last time. Now it's come back here. I'm going to buy it again at this price. I'm going to buy more and accumulate at this particular price. And so that's what's causing this little bit of support we're seeing right now, most likely, right? Kind of right off of this 4,300 level. However, there's not a lot of support below that because we went straight up from basically 4,200 to 4,300 in just a few days there. And most likely, if we do come through, we'll come back down to that 4,200 range. And that's actually okay. That's part of this process. That's how this works, especially in a market where, we're still trying to figure out inflation. We're still trying to figure out what the Federal Reserve is going to do, right? And those are big issues that are happening. And so last time we had this show a couple weeks ago, I talked about kind of the stretch of the market. And it really revolved around a question as how did you know, or because as you recall, in the middle of July, I started talking about the fact that the market was too stretched out. They were probably going to be heading into a consolidation period, and that's been quite true so far. And really, it had to do with kind of looking at these moving averages. So I just inputted the 200-day moving average on there, this blue line. So every point on that line is an average of the 200 days prior. Right? And so it just kind of smooths it out. And then I'll put a 50-day moving average in there. Same thing. Every point's an average of the 50 days prior. And then I'll take out the price. So I like it. I like this chart. I look at this kind of chart all the time. It just helps me. And what I'm looking at is different things. When does the 50-day crossover either down through or up through the 200-day moving average? What is the 200-day moving average? Which direction is it going? So it's definitely going up. That's a really big deal. That's a lot of momentum coming upward at us. But then the other thing we look at is stretch, right? So I talked about this last week or last show. And so we got this very high stretch. There's a 7.5% differential between the 200-day moving average and the 50-day moving average. And if you look back historically, and I look at these on a percentage basis, it's pretty high, right? So the market got ahead of itself. Why did it get ahead of itself? Well, we got a whole bunch of things happen at once. We were consolidating sideways there for a while because of the debt ceiling argument, right? And then that got resolved. At the same time it got resolved, NVIDIA came out with their quarterly earnings report, and everybody started to discover this concept of AI and how it might work and who might make money from it. And we saw this jump. And of course, once you get a little bit of jump in a market that people are doubting, because at that time there was very heavy, expectations for recession, right? Well, you got a lot of people shorting the market, expecting those expectations to actually happen. And so market starts jumping upward and people have to cover those shorts. And so we get this huge run up. Well, all of those things are great, but they're not really permanent things. The debt ceiling isn't going to be renegotiated again until 2025, those types of things. AI might be permanent, We'll see how that plays out. But for the most part, it kind of gets ahead of itself, gets stretched out. And if you look at where it is now, we're at 6.8%. So it's okay. This is what we're supposed to be doing overall. We're supposed to be kind of consolidating and bringing that stretch back down. And a lot of times you need to go down to go up. Okay?
Yeah, the market's emotional, so you're going to have that greed and fear kind of cycles back and forth.
Yep. And you get down a little bit, and some people start to come in and buy. You get down, and again, I think we probably are going to get down to that 4,200. I wouldn't be surprised. It just doesn't seem like enough support where we are now, and there's enough, selling going on. But you get down to a price where people say, wow, okay, I'm going to take that, right? And you get people to come off the sidelines. The amount of money in money markets, I saw a thing of $5.6 trillion is sitting in money markets. Much of that has moved in during this, downturn. That can come back as things start to get better again. And, we do have a seasonality here. The low for last year was October 13th. right? And so here we are, September, which is historically, on a seasonal basis, one of the softest month of the year on average. And then October is kind of a weird month. Everybody associates October with kind of the crashes because the 1929 crash, 1987 crash happened in October. However, October is actually a decent month, but again, I still think there could be some seasonality follow through here, especially with that much stretch that's happening. However, all of this just means that, at this point, until you start to fall apart, okay, 200-day moving average starts to come down. We're in a different market, right?
Yep.
Different concepts. The 50-day moving average crosses through the 200-day moving average, high down through it. That's not good either. We hit new lows that are lower than the previous lows. If we look back, all the lows since October have been higher and higher, right? So none of those things have happened. I mean, none of them. So you have to assume at the moment we are in an upward market, and you kind of operate in that environment, and you keep that mindset until these other things do happen. New lower lows, 200-day moving average down, 50-day comes down through the 200-day moving average, et cetera. There's a whole bunch of pieces that we have that we look at as far as that goes. So now our signals, as a whole right now are fairly accurate for what's been happening, right? So we are on the stock market signals, we're basically on our fast signal, we're red, and rightfully so. When we've been red for a little over a week, and the market has come down all week. So there's a little bit of momentum on short-term basis to the downside. Our slower signal is yellow, which again, that seems pretty accurate too. If you're going to have a consolidation period, this is a caution spot, because it could turn into a downturn. And so you want to be cautious. And so new money that's coming in, we're just waiting. We're holding on to it. I've got some clients that want to move up from 40% to 60% stock or something. I'm telling them to wait. And one of the things I'm waiting for is I'd like to see us break out of this consolidation zone, break out to the upside. Now, the bond market, on the other hand, is having much more difficulties. We've had double reds on the bond market, and we've been out of the bond market with a majority of our holdings for quite some time, and sitting in T-bills and waiting for this to come around. The bond market is struggling with a couple of different things, actually. Number one is, of course, we're in an inflationary environment.
Yep.
And the threat of raising interest rates, and the Federal Reserve talking about higher for longer, and all these things are creating a problem for the pricing of the bond market. Now, the yields are good. The 10-year yield is at 4.5% now, that kind of thing. But altogether, the other thing that's happening, of course, the Federal Reserve is moving bonds off of their balance sheet. They were called quantitative tightening. It was quantitative easing when they were buying it during the pandemic, and that was making the price of bonds go up quite a bit. And so, we're watching that with interest and see how that plays out here. But for the moment, it's kind of a different story. No big stretch, no big run up there. Kind of a sideways motion all year long, right? Yeah. Up and down, sideways, but still sideways. And so, really interesting time frame as far as that goes. I'm still optimistic, as I should be, because right now we're in an upward market, and until we turn into a downward market, I try to keep that mindset and keep moving until we start to see some proof that we're in a different market. Because all we're doing right now is making a sideways consolidation move, and there's nothing wrong with that. I think that's actually very healthy. That's what will allow us to get back up to these new all-time highs as far as that goes. Okay, so anyway, that's what's going on this week. I know it's not a great week, but it's not a bad week either, in the sense that, this is what a healthy market does. It has these consolidation periods. Again, that could turn into a downturn, and we'll react to that, but it hasn't yet. And so let's just keep watching it and see where it goes. But at the moment, it's just going sideways altogether as far as that goes. So let's see how this plays out, and look forward to, again, discussing this again next week. All right, so what do we have for questions today?
So this is a follow-up question to our break-even age video for Social Security. How would the break-even age change if I invest from my full retirement age to 70? So the idea is that if you could delay, or you could keep more money invested in that sense.
Okay, so this, I'll share this slide that we showed last week. Not 2 weeks ago when we did a show. So last show. So what this is showing here is just, what's the break-even age? If I'm 67 in this case, what if I waited till age 70? Well, what's happening is for 3 years, I'm not getting money I could be getting,
Yeah.
right? Now, 3 years from now, I'm going to get more,
Hmm.
but when does that more catch up?
Yeah.
Yeah. And so from this slide here, you can see I have lots of numbers here, but I got a couple red arrows on the columns that really matter.
Yep.
And what happens is it stays bold when you're ahead in one scenario. So the green scenario there stays bold until age 79. And then the yellowish mustard a colored scenario, which is where you waited until age 70, right? You can see you got $0 for the first 3 years, right? It starts to pass it up. So this is total accumulative benefit that
Yep.
you got in those two scenarios. So after age 79, you're losing. Yeah.
Mhm.
And so again, in this particular case, if we assume Social Security is going to survive, which I do personally, but then you have to, am I going to survive?
Yeah.
Am I going to make it past age 79? It's hard to tell, but on average, should. And then I would be better off have waited in that particular case until age 70. Now, the question that came up, and this is an interesting question, I did seminars for Social Security for quite some time, and this came up quite often. What if I took the Social Security, I don't really need it, but I took it at age 67 and I invested it?
Hmm.
Would I be ahead? How much longer would I move out the break-even age? So it's a really good question. I will say one thing that's very important to understand. Although I've been asked about this a lot of times, and have had 6,000 financial plans I think we've done, and hundreds and hundreds of clients. I've actually never seen anybody do this.
Yep.
So keep that in mind. It's obviously not an easy thing to do. Again, I've never seen anybody do it. But let's just look at the numbers and see what happens. All right. So he's made up a little spreadsheet here. So we got same thing, $2,500. Now we're going to use different interest rates here. So first, we're just going to use a 6% interest rate.
Yep.
A simple, could go more conservative. May put it in CDs or something, because that's one of the things we have to figure out here is, okay, we're going to take the money for 3 years. Every single month, we're going to put it in some investment and we're going to keep it. What are we going to earn, right? And honestly, we could actually lose money too, which, we won't talk about that here. But and so the effective interest rate is 6.17%. That's just because you're compounding monthly by putting the money in every month, and 12 months in a year. And let's just say that the cost of living increase average for Social Security is 2% a year going forward.
Yep.
All right. So if you look here, the dark blue shows when you're ahead on one or the other. So taking at full retirement age, in this case, age 67, you're ahead until age 80. Okay, so the break-even point with no investment was 79,
Yep.
and it's now 80 by making 6%. Okay, so it added another year to the break-even point, which is something. But again, if I feel like I might live past age 80, I still might be better off waiting until age 70 to take my Social Security in the numbers scenario.
Yeah, the thing is, with investments, there's always a risk. And so if you're guaranteed 8%, that's why usually we take investment out.
Yeah, that's right. That's one of the things, the growth on your Social Security is guaranteed to grow at 8% a year. And so that's where it makes it difficult to pass up as far as that goes. But let's look at some other rates of return. And so this is from Vanguard. They have a really cool thing. Anybody can look this up. You look up Vanguard risk return chart, and this is the first thing that comes up in Google, at least for me. And what they've got here, and again, I left all the small print in here, so if you guys want to stop this and read this, but they have done a calculation, a really long-term one, from 1926 through 2019.
Yeah.
So the Great Depression, the World Wars, to, the whole, 2008, the pandemic, all of it's, not pandemic's not in there, 2019 is the end, but, it's enough of a time frame to be more, sure of what the numbers are. So average rate of return for a 60% stock and 40% bond portfolio is 8.77. The best year was 40. So that'd be great if you have to put your money someplace, and you made 40, that'd be spectacular. The worst year would be negative 27. So, and it lost 22 out of the 94 years. So this is something to consider, where are you going to put that money and what are you going to make? Because we know we're going to make an 8% guaranteed return, right, on the growth by waiting from 67 to 70 in this case.
Hmm.
Here I can make 8.77% by taking the money, right?
Yeah, but one of your years could be possibly down.
Yeah, so that's important to understand. And, there's a better chance that they're not, right? There's only 22 out of 94, but there is a chance.
Yeah.
Yeah. And so what happens if it grows at 8.77% instead? Well, kind of the same thing, all same parameters, just change the rate of return. The effective, interest rate's now 9.13 because of the compounding. It added one more year, right? So now we're up to 81 if we can make that kind of money on an average basis over this time frame. And there's a lot of little nuances here, because when you're dollar cost averaging in the market, you could actually make more money because you bought a couple times where it was low and it comes back at the end of that 3-year period. There's a couple different pieces here that are interesting, but it added another year. And then let's say somebody wanted to go more aggressive. I remember one time a gentleman in the audience said, well, I make 12%, and I actually met with that gentleman and he was making really good money, but that was during the really boom times of 2020. And I'm not so sure he did that forever. But if we look at the long-term return for the market itself, it's 10.29%, right, from 1926 to 2019, according to Vanguard. Best year is 54, worst year is 43. That's a calendar year. Yep. The worst drop was actually 87% from high to low. That was a Great Depression, but nonetheless. And 26 years of loss instead of 22, right? So still a chance of some loss. What happens if we up the return to 10.29? Effective rate goes to 10.79. Mm-hmm. It didn't actually change the years. It's still the same. Not enough differential in rate of return to move it. It's still 81 is the break-even age. So if you live to 82 or beyond, you were better off in this particular case waiting until age 70. And again, there's a lot of little nuances here. We're still kind of scuffing over the surface here with this, but I think this is a really interesting look at it. I don't have any real problems with people taking Social Security early. I do think, understanding the math, and then it just comes down to, what's your personal outlook. Again, the things that I see are pretty consistent. People want to take it early because they're afraid they might not live that long, which is legitimate. Or they feel like Social Security might go out of business and they want to take what they can while they can. I'm not so sure I agree with that one because that's been the concept of the Social Security going out of business has been talked about since the 40s. Yep. And I think it continues to go. It's too important. Too many people need Social Security. So then it becomes an issue of, can you afford it? Mm-hmm. Right? So 58% of Americans take Social Security at age 62. Only 8% take it at age 70. Right? And a lot of that, in my opinion, is because people need the money. Right? And so they can't afford a standard of living without it, and they take it as soon as they can. And it's, and that's what it's there for. It's a safety net. There's nothing wrong with that either, right? You do it. So, but if you can afford it and you feel like you might live for a while, then really need to look at these numbers and kind of consider what you might be able to do.
Yeah, and you're always there to take a gamble in a sense. But you're kind of, how do you weigh the odds? How do you stack the odds in your favor?
Yeah, investing and finances are a lot about probability, right? So when I'm in right now, the market is in an upward trend, right? It is. And so the probability is that it stays in that trend. As a matter of fact, if we look at that 94-year period, only 26 out of 94 years did it lose money. So the probabilities are up, right? Mm-hmm. And so we invest with that probability in mind, right? And so this is a probability analysis also. And so the probability here is at age 70 works pretty well because you're likely to live past these points of time. And again, here's the thing that I think about. When you pass away and all your family's around you and what have you, nobody's going to be bemoaning not taking Social Security earlier, right? Mm-hmm. However, I do have clients that bemoan the fact that they did take it earlier because now they're in their 80s and they are struggling somewhat financially and could have used more money, and they took it just because they wanted to take it.
Mm-hmm.
And so I think that's the bigger risk, is that long-term living longer and not having enough money to keep up with everything. And so upping the amount that you can get from Social Security, I mean, so this is $3,496, right, at age 70 versus 2,706 is what you're getting if you take it at age
so
67.
An extra $800.
That's a lot of money. It's, it's just going to come every single month, right? So that's not bad. So that's, that's significant to me. So something to think about along those lines. Anyway, so that's a great question. Appreciate whoever asked that in the comments, and keep them coming. Put them in comments, send them into the email address, anything you'd like. We'll try to answer them. Oh, can't get out.
Oh.
There we go.
Up.
What happened?
Not sure.
Can you move it yourself?
Oh.
Yeah, there.
Okay.
Okay. All right, what's the next question?
So, what is the Fed dot plot? Why is it important, and how do you read it?
The dot plot. Okay. This is a 4 times a year. Federal Reserve meets 10 times a year. They don't meet in August, and they don't meet in October, right? In August, they do the thing in Jackson Hole. They get other Fed people coming in from around the world, and they, have a meeting and what have you. But the dot plot is important because what it does is it projects, what rates of the Fed rate might be. I figured out what I did wrong here. There we go. Pushing the wrong button. All right, this is hard to see.
Yeah.
But just conceptually understand what this is. It's by year, so 2023, 24, 25, 26, and then right here where my cup is says long term.
Yeah.
Yep.
Long run.
Long run.
Basically. Yeah.
All right, and so what happens here is each one of those dots represents one of the Fed governors.
Yeah.
And what they expect.
Yeah, so it's kind of like where they cast their vote. And so it's like casting a vote for end of 2023 is like, as you can see, that it's quite condensed, and there's only so much wiggle between each vote.
Yeah, and so there's more votes for a higher rate is what you're seeing there. That pattern.
One more rate increase.
Yeah, if you look at that set of dots that's longer, those are the people that think we're going to have a 1/4 point increase versus the people that think we're going to stay where we are. And so the majority of the Federal Reserve Board feels like we're going to have one more rate increase this year. And so, and that's important because the market is essentially at a point of neutrality where they feel like there won't be another rate increase. And so that's where there's a bit of disconnect, is one of the reasons why we're seeing some fall in the market as it's starting to absorb the fact that the Fed might be raising rates more. But what I find very fascinating about this is some of their projections going forward. We probably can ignore the 25 and 26 because that's really getting out there.
Yeah.
But if you look at it, the overall trend, the Federal Reserve Board expects interest rates to be coming down.
So they expect some sort of slowdown that causes them to reduce rates.
Yeah, exactly. Or we just get back to some normality where we don't need to have such a restrictive policy where things, they want to keep us from slowing down too much.
Yeah.
But they need slowdown, and we've had some slowdown already, right? And so that's the whole object of this inflationary environment, is to kind of raise rates enough to slow things down.
Yeah, keep you in that Goldilocks zone.
Yeah, exactly. You don't want to raise them too much where you're having to lower rates in a fast motion to save us from a steep recession, right? And which is where the risk is in all of this. But it is interesting to me that even next year, the expectation is that the rates will be lower. If you look at the majority of those dots, they are below where we are. There's always a couple of high ones. It's kind of interesting.
Outliers.
Somebody thinks it's going up. But overall, expectation is for lower rates. I'll tell you what, if that happens, the market's going to enjoy this. And, generally speaking, when things do slow down and the rates start to come back down, even if we're heading for some trouble, oftentimes the stock market can do quite well in that environment. It depends. If you have something really dramatic like 2008, that's not true. But in a typical slowdown, you could see a scenario where the market does quite well in that environment because the market really reacts to the Fed. And
Yeah.
when the Fed is going down, the market goes up. And so that's what a dot plot is. And then you can even see in this particular chart here, I think this is kind of fascinating. This is from Yahoo. And basically, the blue dots are from the June meeting, right? Again, they only do this every four times a year.
Yep.
The purple dots are from the September meeting. And so one of the things you can see is that there is, more of a, for 2023, more of a consensus, I suppose, around, staying the same or going up,
Yeah.
right? Compared to where we were in June. And then if you look at for 2024, those purple dots have moved up.
Yeah, you can see that shift towards
Yeah.
keeping a higher interest rate.
Yeah, exactly. So there was in June more expectation for lower rates amongst the majority of the Fed board members, and now that's moved up some. And again, this is why the market's responding, the way it is. These dot plots are important to the market. In the end, it's kind of interesting to see where the market, where a Fed funds rate actually ends up, right?
Yeah.
But that's what a dot plot is, and that's why it's important. It's why the market looks at it. It's why the market's reacting probably the way that it did yesterday, for example, too. So, good question.
So with all the news, as the Congress heads back out for the weekend, how does the government shutdown affect the U.S. economy? The government possibly shuts down next Friday, I think, is when the budget runs out.
Yeah, the government shutdown is kind of interesting because we have all these things happening, right? We have oil prices coming up, we have a auto union strike, and we have the possible government shutdown. I suppose those are the big three, I suppose. And so what impact does that have? So, for example, the auto union, well, that's kind of a big deal. There's still money flowing through these strike funds and what have you, so maybe not as much of a down impact from that with money being cut off from spending from a big group of people. But they're also creating supply of cars and trucks. If the demand stays the same, you could see an increase in price and supply, right?
Yep.
So what happens when the government shuts down? Does that change supply?
Not really, because what does the government supply?
They supply services and what have you, so there's some impact there, but the services are already included in our taxes. And so it's not like I'm going to go buy a Ford truck and now there's less Ford trucks and I'm going to have to pay more. I might have to wait longer for whoever it is, the IRS or whoever department gets affected.
Yes, so like non-essential will shut down. So like you'll still get your Social Security check, but if you're making an application to Social Security, that might not get processed.
Yeah, so let's look at what the market thought of the last government shutdown. So December 22nd, 2018 to January 25th, 2019, right? This is the 35 days. It's the longest government shutdown in history. The stock market went up quite a bit. Now, honestly, looking at that and remembering that time frame, the government shutdown wasn't the reason it went up. You can't see this, but that was a 20% drop that ended on the 24th of December. And then the Federal Reserve started cutting interest rates and the market kind of came up from that. So again, I always say this is kind of fascinating. Who's president and the government shutdowns are not nearly as important as what the Federal Reserve is doing.
Yeah.
And this is not a debt ceiling debate.
Yeah, the government still has the money.
Yeah, they're still going to pay the bills. They're just maybe not going to be paying some of their employees for a while, and then they have to make that up. And it's kind of an interesting thing. But from a stock market standpoint, it's not. I wouldn't say it's a great thing, but it's not a devastating thing. A debt ceiling default could have been a devastating thing. A lot of strikes or anything that really restricts supply, I think, will be a really big issue for this environment where we're already in an inflationary environment. Where so there's some need to kind of get that fixed, and hopefully that resolves itself sooner than later. But anyway, that's what's happening with the government shutdown, at least historically. Shouldn't have a massive impact here either. Again, it would impact you personally if you're an employee. My wife worked for the government for a long time, and one of the things she mentioned yesterday, which is interesting, was every time there was a threat of a shutdown, they would start to get notices. She says there's an awful lot of work that goes in, even already right now,
Hmm.
behind the scenes. She would get emails saying this is what's going to happen, and this is how it's going to work. So just the threat of the shutdown is causing all kinds of work to happen right now too.
Yeah, I know the White House sent out a memo, I think last Friday or this Friday, about the shutdown and what they're preparing and all that stuff. So it is everyone's well aware of it.
Yeah, it's interesting. All right, and what's our next question?
What can we expect with rising oil prices? As the last couple of weeks, the oil has climbed to almost is $90 a barrel around.
Yeah, that's right. So that's a big deal, right? I mean, oil is in everything.
Hmm.
And I remember one of the conference calls from Target. After the Ukraine was invaded, and oil went to like $130 a barrel, and their stock dropped, I think, like 24% that day, or that shortly thereafter. And one of the things that they talked about was the fact that the transportation costs were going to go up $1.2 billion dollars
Hmm.
was their projection for the next 12 months based on the cost of diesel and fuel and what have you. And so, that affected immediately the stock price. It
Yeah.
was not the only thing that affected it, obviously, but the stock price of that stock, maybe, the prices that you're having to pay at Target for things that, you see it very directly when you put the pump into your car and you see, I just filled up my van. It cost $101. First time it cost me more than $100 to fill my van,
Yeah.
last week. So, we can tell right away what's happening. However, let me put it in perspective here. Let me share this slide. So this is going back to 1967. This is the price of crude oil. And so again, if we look at where we are now, around $90 a barrel, we've been around there a lot,
Yeah.
and we're still going along. If you look, a big chunk of that time from 2010 to 2015, it looks like roughly the same $90, $100 a barrel. The markets were pretty okay. Inflation was okay in that time
Hmm.
frame. You know, that's not the really big issue. Look back at the very beginning. This is a logarithmic scale, which just means that, it's essentially on a percentage basis.
Hmm.
If you look back in 1964, 63, I believe it was around $4 a barrel.
Yeah.
And then by 81, it was $41 a barrel. That
That's a
is
big jump.
that is significant. Think about that. And so that hyperinflationary period that we had at the end of the 70s and the 80s was, at least partly responsible from this oil jump. That's a big deal. Think about that. We're at $90 now. It would be like saying we're going to go to $900 in over the next 8 years, which, anything's possible. But that's an oil shock, and that's the thing that really, we have to worry about. It's at 90, it goes to 100. The Saudis and Russia pull back a little bit. I mean, look, we've been at those levels for a long time. And it is important. It's not unimportant, but that big inflationary thing that everybody worries about that happened back in the 70s and 80s was a much bigger deal. Was, to put that in perspective, we're nothing like what was happening then.
And the thing is, when you think about oil too, all the price increase has been kind of like an artificial cut of supply that's controllable. If price goes to a certain point, they people want to make their money, and so they'll start to produce more, and so it's kind of like controlling that supply and demand is what the market does.
Yeah, that's a great point. I mean, at $130 a barrel, all of a sudden it brings some fields and players into play that couldn't afford to do it at 90,
Yeah.
right? Because they have higher costs of gathering the oil or refining the oil or whatever it is, right? And there's the other thing is that eventually those producers like Russia and Saudi Arabia, if things start to slow down, economically, or if, if the demand for oil starts to fall, they don't want that either,
Yeah.
right? And so they'll find that sweet spot and bring it back down. It looks like the sweet spot is roughly around where we've been,
Yeah, they're trying to maintain a price.
for now. And so, yeah, that's one of the differences too. Is that it isn't that there isn't oil out there; it's that they're deciding to
Hmm.
pull it back. Well, if it gets to a price where people stop using it to a large degree and they start making less money. So if you can sell X number of barrels at $100 and then it drops significantly at $130 to the point where you're making less money at $130, then you're going to drop the price back down to $100
Yeah.
by producing more and putting more out. And so, it's a manipulated scenario, but it isn't like what we had in the 70s, which to me is the big concern because, we had the Fed funds rate that we just talked about here was 5.25, 5.5%. It was at 19% in 1980. So, and that was partly because what was happening here with the oil piece. They were just trying to knock the economy down so much that people weren't using as much energy to kind of bring that under control. So anyway, that's what's happening there. I think it is an interesting area to look at. All right, we have maybe time for one more short one. Is there anything else
Yeah,
came
sure.
in?
Can I consider certificates of deposit as part of my bond allocation in my portfolio?
Yeah, so if somebody has, say, 60-40 portfolio, right? 60% stock, 40% bond. Can you include, so can I take some of that 40 or all that 40 or whatever and put it into CDs and say that's the portion of my portfolio instead of, bonds? The advantage that bonds have typically is that they will go up when the stock market goes down. That was not true this time because in an inflationary environment, that's not true. When they're raising rates as fast as they did from 0 to 5.25 in a little over a year, it hits both the bonds and the stock market. Now the stock market's down 28%, bond market was down 21%. So bonds did a little bit better. So there was some. However, making back then you would have made 1 or 2% in a CD. Now it's 4 or 5%,
Yeah.
5.5. So making money is better than losing money in the bond market. I actually don't have any real significant issue with putting some CDs at this point in time as a portion allocation for the bond market portion. We're double red right now on our 2 bond market pieces for fast and slow. And really, we are probably a little ways away before we start to see a healthier bond market, right? However, we covered the dot plot today, right? And the Federal Reserve chairman as a whole expect interest rates to be lower by next year. And once rates start to come down or even to settle down, the bond market's going to get healthy real fast.
Yeah.
And it's going to do really, really well. And I still think there's some opportunity here. So maybe it's something like, still staying 30% bonds and 10% CDs or something along those lines. And even keeping those CDs on a kind of a shortish leash. Although if you wanted to hold them, permanent 10%, I'd probably go longer because if rates do come down. But if I wanted to convert it back to bonds, then I would go shorter, right? So you kind of want to see what's going to happen. So maybe split the difference, 5% in something in the 2 to 3 year range and 5% in something in the 6-month range.
Yeah, because the thing with CDs is you're kind of stuck with it once you get into it, unless it's like a tradable CD, which is not, most people don't have access to, or it's a little bit harder to get access to.
Yeah. No, that's a good question. I think it's the right type of environment to look at that. There's some decent rates compared to, it's ironic because we used to get much better rates not that long ago. But they went down to basically 0 or just about 0. And so 4 or 5 sounds awesome. That used to be terrible. So, it just depends on reference and, where we're at any point in time. But that's a good question and something to definitely consider. Okay, good. Well, that's our show for today. Again, we'll be here next week. Look forward to, seeing any of you. Send in your questions now. Anything, you put them in the comments on the videos. You can put, send us the questions on Ask Tom at talkmoneywithtom.com email, and we'll try to, incorporate those into the next show and what have you too. Of course, continue your education. Subscribe to the channel. It helps us too. We're definitely making a push for subscribers, and hit the bell button if you want to get notified when we, put things out. And then, of course, you can meet with Ethan and I and ask questions, one-on-one. Go to the book appointment button up in the corner, and we'll be happy to meet with you. So look forward to seeing you next week, and see you then. Thank you very much.